the market is going to interpret that CPI data, but it's going to interpret it alongside the oil shock. So if you think about it from that perspective, a soft CPI print may offer only limited relief, I would say, if traders think energy-led inflation is about to re-accelerate it. So even if Good afternoon, ladies and gentlemen, and welcome to this afternoon's Markets Now event. Hope you're all doing well, guys. We certainly woke up to a bit of a shock this morning, didn't we? Things have gone completely haywire over the weekend. Middle East conflict continues to soar, and Brent prices and crude shot up to 120. Which I think has got to be the highlight of the year. This one, I mean, I was expecting some craziness out of this, but not to that scale. I mean, as far back as I've got data access to on TradingView, it shows you 2013. But on my Traders Workstation, this is the single-handed largest move in this same period of time that we have seen in the last 23 years. So it's extreme. It is on the extreme end. It really is. Obviously, we have a lack of the market report this week. I was toing and froing about doing a market report, as is obviously the normal practice here with the UTC. But I did refrain from launching a report this week just because of the nature of the context that we're trading in. I just felt like the first part of the market report at least would be redundant with the amount of volatility that we could potentially be facing and stuff. So I just felt like it would be prudent not to release a report with trade specific ideas and provide the more, just focus more on the day-to-day live coverage of what's been going on as per the message I sent out this morning, as I'm sure you will appreciate. So looking at UK Brent at the moment, we're currently trading at 100.5. It is really powering down quite well. We're coming to close the gap soon enough. This is a serious, I would say, like a black swan event. I wouldn't classify it as anything else. This has definitely got that feeling of a black swan event in here. 15-minute time frame. As I mentioned, we're powering down at the moment. Beginning of the gap starts soon, and then I would expect we continue trading right the way back down to the sub 95 area to 93.235 at least at the beginning of the gap. At the end of the gap, which is where the weekend close was, the Friday close. Good afternoon to you, Cortim. Good to see you, buddy. Good afternoon to everybody else out there as well. I appreciate we've got a few heads in here. We've got Nadia, hello there. We've got H&C. We've got Jack. Jack, haven't forgotten about your message, buddy. I will respond to you in due course. No worries. About fitting in a call with you at some point this week. That's not a problem. It shouldn't be a problem at all. So yeah, I'll definitely, I'll do what I can. It shouldn't be a problem. We'll work that one out. Yeah, so it's just craziness right now. So I've got a lot of stuff. I've been doing some research. I've got a lot of information here. We're going to dissect it together. So instead of a market report to break down, to be honest with you, it's probably going to be even more content heavy than a usual Monday afternoon. So just bear with. There is a lot that I've taken through consolidating information from various sources. The sources I personally deem to be reputable with their information. So it should be pretty good. So first of all, the first thing at the top of everybody's agenda in the markets at the moment is the Middle East risk. And it's now the market's number one macro driver. Okay. Now, if you think about it, the key shift is that this is no longer being treated as a background geopolitical noise in a manner of speaking. Okay, it's always been there, and we've been dealing with news from the Middle East and the various geopolitical situations that have been developing there for quite a while now. If you think about it, it's actually, it's been going on for some time. But this is no longer the case. It is, well, as I already said, it is the number one macro driver in our markets. Markets are actively repricing the risk of a prolonged conflict involving the US, Israel, Iran, and other nations, which I won't mention at this stage, but I am very confident that they will be getting involved soon enough. As you guys may have noticed me discussing with, what's his name in the general chat, Bacon Dude in the general chat. He's a really cool guy, by the way. He'll be joining us on a full-time basis very shortly. But he's actually he's a pretty knowledgeable guy, and I trained him in the past. So yeah, it's he'll be a good voice in the room for sure. But as we were discussing, there is another even darker cloud that is looming over the markets at the moment, and we're all thinking it. And that is the fact that the Middle East has had generational close ties with China and Russia. And with the state of the situation at the moment, and the multiple battles that the US is now starting with all of these nations, the risk is that Russia and China are going to start smelling blood in the water and an opportunity. And if that takes place, ladies and gentlemen, that could very well be the beginning of life-changing kind of environments for us all. Every single person, predominantly in the Western world, in the global North, as it's called. So there's a hell of a lot going on at the moment. I mean, portfolio managers and fund managers all over the place will be working. I guarantee you will be working 24-hour shifts at the moment, around the clock, working hard to rebalance things and to prepare for the potential escalation as it develops in real time. So it's just really, really crazy out there at the moment, and very scary as well. Very scary. So the repricing of risk, as I mentioned before, this comes as, or with a direct concern, I would say, around energy infrastructure. It's also with Gulf production and also shipping through the Strait of Hormuz. Now, Reuters have suggested that investors are now watching the scale and duration of the war more closely than ever, to essentially measure that risk and be able to determine, kind of 2, 3, 4, 5 steps ahead of where we currently are at the moment, which at this present moment in time does not look great. Number 2 is that oil is the absolute clearest real-time expression of the market fear. Okay, now I think this is really, really important, because if you look, yes, okay, it looks disgusting at the moment in terms of this massive spike up and spike down, but this is global fear, and this is really, really it's a very clear visualization of where market sentiment currently is, in this massive explosive move. Now, as I've already mentioned, Brent surged to roughly 119.50. That's the highest level it's been since 2022. It's almost at all-time highs, and it got there in the space of a couple of days. And that matters because oil is no longer just the energy story. It is an inflation story, which I've already touched on last week, maybe even the week prior as well. It's a rates story, and therefore an equities valuation story too. So it really does have a bleed out effect into the rest of the markets and the rest of the global economy, and what we're all looking at and how we're all feeling here. And number 3 is that the market problem is not only war risk, it is war driven inflation. Okay, so things like, if you think instead of bonds, for example, cleanly catching safe haven bids as they usually would, yields have been pushed higher in parts of Europe and the UK because traders are now focusing on the inflationary impact of oil shock and what that's going to look like, especially at the end of a massive battle on inflation. All this is going to do is send us right the way back to where we were at the end of 2021, which is, as you can imagine, really bad. If you think about the stress on the global economy at the moment, especially like places like the United Kingdom, for example, or the United States or any of the other Western nations, some of them have got off less harshly than others. But if you imagine where we are now as a result of the last 4 years from a day-to-day economic perspective, and then you're thinking, okay, well, we started on that inflationary battle in a much better place than we are now. Okay, so if we have to go through all this again, you can see where I'm kind of going with this and where the market's going with this. The number 4 thing is that the US dollar is benefiting from the scramble for liquidity. Now, again, we've dug into this pretty deeply. We know that the US dollar is the main purchasing power behind, well, it's the world reserve currency, so it's the main purchasing power for military assets. And also, it is still the safe haven. It's still acting as the safe haven. I know we had a conversation around the fact that we may see the beginning of the Euro safe haven climate. That doesn't seem to have taken place, granted, and it is going back to the US. But we have money fleeing to the US from a safe haven perspective, but also the demand in the dollar for military assets and stuff. So military purchasing power. Now, I mean, all things considered, there we are actually still trading in 99.20, which I find quite surprising, especially where US crude was trading as well. I would have assumed that the dollar would have been dragged up in the throes of it a little bit more than it has been. But I know also that we're trading into some pretty big cash-rich areas, and so there's still going to be a lot of people up there with US assets across the board that will be sort of hesitant to start bidding up dollar because of other investments that they've got going on, and that might be why we're not seeing too much of this crazy rally in the dollar just yet. But make no mistake, I do believe that is around the corner. Now, the 5th note, just to get us off the ground, is the fact that Wednesday's CPI is still going to matter, but it's just going to be viewed now through the lens of the geopolitical concerns that the market has. And when I say that, so it's like the February 26th release is going to be, if you think about it, under normal conditions, let's say, it would be a really clean inflation event, generally speaking. But like everything that we've been doing so far in the markets and the news events that we have been trading, and now this week more than ever, the market is going to interpret that CPI data, but it's going to interpret it alongside the oil shock. So if you think about it from that perspective, a soft CPI print may offer only limited relief, I would say, if traders think energy-led inflation is about to re-accelerate it. So even if we do get a miss on the data and the numbers look really good and the Fed's winning, they're beating inflation, I don't think it's going to have the desired effect on the markets that we would usually see, i.e., dollar declining and stock markets rallying, because of the fact that everybody is focused on the broader picture behind the scenes. So we should not be expecting good inflation data, meaning bullish stocks and bearish US dollar trading assets. And that, I just don't think that's how it's going to work. So please do take note of that one as well, because we're going to be positioning ourselves accordingly on Wednesday to try and mitigate any of the potential sort of risk of loss that we may incur from having a more traditional bias from the CPI event, rather than being adaptable and kind of getting focused in on what's going on right here and right now. So ultimately, this week is no longer just about whether inflation came in a touch hot or cold. The bigger question here is whether the Middle East conflict keeps energy elevated long enough to reprice the entire rates outlook again. Now, CPI, like I said, it still matters, But the geopolitics is going to decide whether the markets are even willing to trust the disinflation story or if they're just thinking 20 steps ahead. So it's a big one. Now, if we think about, let's think about why this is going to matter across every asset class in terms of what's happened with oil. Okay. So, of course, we've got higher oil, which equates to immediate inflation pressure. And I mean immediate inflation pressure. I don't mean like some of the things that we see in the markets have a longer term effect where we don't see the kind of events of that take place for weeks to months down the line. I mean, the inflation will be rising from this morning, from bloody yesterday, really. That's, so it is immediate inflation pressure. And what it also will do is put a major squeeze on consumer and business margins. In terms of the indices, higher oil and higher yields are a poor mix for equities. Really, really bad mix for the both, especially growth names and broader market sentiment. Now, I also got a heads up from Reuters that noted Wall Street futures were sliding as crude neared the 120 mark. Now, of course, Brent and crude are coming down at the moment, but I do strongly believe that those prices will continue to surge as the US continues the conflict, and we will still see a massive vacuum in demand. In terms of bonds, normally geopolitics can support bonds, historically speaking, but inflation fear is overriding that in both the Europe and the UK, which is then going to squeeze the higher echelon of business here, and then that will have the bleed out effect into the consumer level. And then finally, thinking about FX, well, the dollar is gaining as capital seeks liquidity and obviously relative safety, and sterling has been notably vulnerable at the moment and very, very weak. So now let's think about this Wednesday's CPI, right? So if CPI is cooler than expected, the markets may initially try to rally risk assets and ease yields. But if oil remains elevated at the same time, traders might say something like, I don't know, that's backward looking data, and that the new inflation pulse is being created right now. If the CPI is a beat, or as analysts expect, then the print and the geopolitical backdrop are going to reinforce each other. And this is where I think it's going to create a mega event where we see something kind of very, very explosive. I can't say how explosive. I don't have a crystal ball. I just have my humble brain. But ultimately, that will be the most exciting in terms of being a trader, in terms of having the CPI event and looking for those action-packed sessions. That is the one that we all want to watch out for. Okay, so just to reiterate that, that is where we see a beat on the CPI print, because then that alongside the geopolitical backdrop, that's like pouring fuel on the fire. Okay, that's like pouring fuel on the fire. So thinking about like a practical market bias framework, then we have to think like base case is headline sensitive, defensive, and unstable. That is what we're trading in at the moment. Sensitivity, extremely defensive market sentiment, and unstable market conditions. As long as the conflict remains unresolved and oil stays, bid, obviously we're looking at the big decline at the moment, but again, just want to reiterate, I do think it will continue trading higher. So long as oil stays bid, the market backdrop then remains fragile. So expect sentiment to stay reactive rather than, cleanly sort of, trend stability and so on and so forth. A nice stable market state structure. Now, in terms of, and if you got a pen and a paper, then feel free. If you're not, then just get this on catch up. You can take notes from it as in when you please. But the major headlines, the key headlines that I am consciously thinking about right now, and in terms of all of my traders, all of you guys in here, we've got 5 main things this week. Okay, the key headlines, or maybe a few more than 5. We've got the Middle East conflict, which has overtaken the usual macro narrative as the market's main focus. We've got Brent crude, which is surged to immense highs, almost all-time highs, the highest since 2022. And this is on purely off the back of supply disruption fears. We have the situation that we had several years ago, where the Strait of Hormuz is back at the center of global macro risk pricing. We've got the UK glitz, the Eurozone bonds, and sterling, which have all been hit as traders reprice inflation risk. We have the US dollar, which is benefiting from bloody everything. I don't know why it's not higher than it is right now, but rest assured, I do think it's going to get there. So look at a very, very strong and sturdy dollar for a while, because like I've been saying for a couple of weeks right now here, team, we've got every nation in this conflict, the US, all of the Middle East. I mean, Trump's talking about invading Cuba. He seems pretty serious about it. Cuba are having complete energy blackouts at the moment because Trump obviously then took over Venezuela's oil production. Oil was being sent to Cuba by Venezuela for their energy infrastructure, but then Trump didn't continue doing that for Cuba, so Cuba are in the darkness, which is why he thinks it's prime time to start invading them. And yeah, so I mean, so the dollar's demand is I mean, it's going to be incredibly. It's just going to be higher than we've ever known it to be, ultimately, because every single nation is going to be using US dollars to purchase everything that they need that's of any importance to them from a political perspective, I suppose. We've got US February CPI, which is due Wednesday. Think about the geopolitical aspect of that. I've covered that already. I'm not going to repeat myself. And then finally, we have a market which is increasingly focused on whether the oil shock delays are going to derail the expected easing path from central banks, which we have now been on the journey with for the last, what are we in, 2026, so 5 years. And we're so close to the finish line. Really, we're probably about a year away from the finish line. And Trump is now ultimately undone, or could potentially have undone all of that work, all of that effort. So, yeah, I mean, it's a hell of a lot, isn't it? It really is. Yeah, it's a hell of a lot, team. It's a hell of a lot to work through, a lot to process, and we now need to, ultimately, day to day, we're not really going to do too many things differently. We are going to be considering risk on even more frequently than we do, that we have done in recent history. We are going to be considering things like risk-reward ratios as well. We need to be thinking about being a little bit more balanced, a little bit more forgiving. And we need to cut down, and another serious thing that I've been thinking about is reintroducing a day-to-day trade limit as well, which I haven't done that personally, and I can internalize these things, but I'm being vocal about it, obviously for the nature and the benefit of everybody in here. But I think it would be very prudent to focus on trading volume as another additional element of risk, because at the moment we don't want to be having increased levels of exposure when we have things like this, and I'm pointing directly at my screen right now, happening at random on a day-to-day basis. All it takes is one man's word, and everything that we're in an instant could fly off the handle at such a rate that a standard stop, unless we're trading guaranteed stops, which I can guarantee none of us will be, we will be wiped out, or at least a significant chunk of money and stuff, which is not conducive to professional trading at all, ultimately. Afternoon, Scotty D. Hello there, sir. No drama. Oh, just reading Jack's comment. No drama. Just been really busy with the holiday. That's fine, buddy. That's absolutely fine. Yeah, we'll pick it up. No problem at all. I tell you what, Jack. Even if you want to take a week off, so that you do get the data in, so that we can have our next trade review together next week. That's fine. Just hit me up after the session, and I'll be more than happy to work that out with you, buddy. That's not a problem at all. So that's where we are. It's a lot, guys. You know, it's a hell of a lot going on out there at the moment. But please rely on me at this point in time as well. If there's any concerns that you have or anything at all, please rely on me. You can rely on me. I'm here, open arms. So if you've got any kind of concerns or anything at all, or you were being interested in something and now you're not sure if you should be, please let me know, and I'll be happy to either I'll even jump on a call with you if you want. I don't care. That's absolutely fine. I think it's very important at this stage as well to keep our heads about us and keep our wits about us. Um, let's try and just be focused on the market element of it rather than the real world element until we are forced to. If God forbid it ever happens, but if it happens, it happens, and we can kind of cross that bridge when we come to it. But right now, it's just important to be professionals at our desks and to try and remain, as sort of prevalent with that as possible. Now, in terms of what's going on this afternoon, let's have a look at our US indices then. That pretty much covers off everything from this week that I really want you guys to get focused in on and pay attention to. In terms of our markets this afternoon, let's have a look. I mean, look, it might be really good that happened because it's a Monday and the US markets are, not looking great at all. Considering we've already been trading in them for half an hour now, they're not actually doing anything at all. So it doesn't look like we've missed out on, any opportunities whatsoever looking at all three of them. So I guess that's the silver lining of the day. We do have a break, close, and a retest on the Standard & Poor's, which may look a little bit interesting soon enough. This level in here is not looking too bad, is it? We get a continuation to the downside. We might see previous lows. Let's have a look on the 15-minute time frame, consolidate some of that noise. So we've got a decent break of structure, 1 minute break, close, retest, continuation. And could we see a move down to 65.90? It might not look too bad. Get a break of structure below the previous low. Don't want to be buying US stocks at the moment. It doesn't make any sense whatsoever. So yeah, we could look at this for the S&P short. I probably have my stop loss all the way up at the highs, to be honest. Not go for anything too aggressive. Nice S&P short there. I really don't like the NAS 100 at the moment. That looks so inconsistent and like no one's trading it right now. The initial breakout candle had no volume in it at all. So yeah, I don't want to be touching that. That looks, way too risky. US 30 Dow Jones, not too bad. It's not as nice as the S&P 500 setup, frankly, but it probably could be used. Again, we'd be looking for the previous low to be broken for the structural breakout for a trade down to this area in here. So maybe not the lowest low, just slightly above it. Break of structure would be there. Again, looking short. Target target stop loss. I mean, that would be like the same kind of trade as the S&P. I would probably choose one or the other. I wouldn't be going short on both of them, team. But nevertheless, they are a couple of decent trade ideas, so I'll let you decide whichever one you want to take. I think from a... Yeah, that's a little bit too long, actually. Yeah, there we go. I really like the S&P. I know some of you guys find the S&P a little bit expensive to trade, don't you? I mean, they're both really good. They're both really solid trade ideas. Yeah, I don't think I have a preference, so you can choose. Yeah, you can choose either one. I'll send those out. I'll send those out. I'll send those out now. fire them into the chat, and then I'll put them in the UTCF Fund Alerts. Scotty D, I'll tell you what, mate. I'm going to owe you a few pints because it is you every time, every year for the past 5 years that has given me a heads up on DST. Every single time. You are like the little voice on my shoulder sort of thing about things like this. I've had myself. I tell you what, team. You know, on a personal. This is on a personal. This is not me speaking to you as the head of the desk, but just on a personal level. My head has been very scrambled recently. These past couple of weeks, very very scrambled. There's so much that I've been doing behind the scenes at the moment. I'm trying to be a portfolio manager myself on top of everything else that I do. And I think I'm just flagging a little bit. Not that that's an excuse for the DST thing in particular, because I get that wrong every year. I always forget every single year. Yeah, it's been a lot. It's been a lot this past couple of weeks. Trump is definitely not making 2026 easy for me, and I doubt he's making it easy for any of us, really, is he? He's a bloody loon. And there we have it. Right, guys. Well, I'm going to pretty much wrap things up there. We are currently 2 minutes past 2. The US Open this afternoon obviously opened up already. It's not done anything at all. So we haven't missed out on any opportunities, which is the good side of things, of course. There are a couple of nice opportunities in the Dow and the S&P short. Don't know if they're going to trigger or not, but I would be happy taking one or the other. I cannot tell you which one I'm gonna go for. It just really does depend on the setup at that present moment in time. I'll try and give you a heads up inside the Traders Lounge as and when it occurs. But honestly, team, they both look adequately good. So it's whichever one you feel good about. If you've got any further questions or anything, please feel free to reach out to me. As I said, open door policy. I will welcome a call with any of you with open arms if you have questions or wish to know more about a particular subject that I have covered here today, this afternoon. Please heed my, not advice, but heed the information that I have provided this afternoon. It will come in handy. It will be shaping the market narrative over the course of the next few weeks, and it is what is important. So please just, bear that in mind. And other than that, have a great afternoon. So take care, team. I will update the events schedule now. So just bear in mind, I will be on earlier than I would usually, which obviously everyone here seems to know already before I do. But tomorrow, it will be the right time. So take care of yourselves, guys. Been a pleasure as always, and I'll see you then. Thanks a lot. Bye-bye.